Today, in this inflationary world, where are the digital chips falling? Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and problem news with a distinctively Australian flavour. In today's show, we look at some of the latest developments in the digital finance space against the latest economic news. But first, the main driver of the economy in the US are consumers, and that showed little hesitation in spending last month, despite the fastest inflation in 3 decades, setting up the economy for a year-end growth spurt. Purchases of goods and services, unadjusted for changes in prices, increased 1.3%. That's the most since March, according to the Commerce Department. Even after accounting for higher prices, spending still exceeded projections, in a sign that consumers started their holiday shopping early. The figures, the main course of a pre-Thanksgiving data feast that included robust orders for business equipment, a surge in exports, and a pickup in new home sales, help explain why several economists upgraded their tracking estimates for fourth quarter economic growth. The reports further complicate matters for Federal Reserve policymakers who are trying to balance rapid inflation on one hand and a labour market still 4 million jobs shy of pre-pandemic levels. Mary Daly, president of the San Francisco Fed Bank, is the latest official to suggest a faster tapering of the central bank's asset purchase program may be needed. The personal consumption expenditures price gauge, which the Federal Reserve uses for its inflation target, rose 0.6% from a month earlier and 5% from October 2020. After adjusting for higher inflation, spending rose a healthy 0.7% as outlays for both goods and services picked up. The combination of higher inflation risks and consumer resiliency means that the likelihood of the Fed accelerating the pace of taper has increased substantially, Bloomberg Economics said. An economist at JP Morgan revised up their fourth quarter GDP tracking estimates to an annualized 7% from 5% following Wednesday's data. Morgan Stanley economists took their running forecast up to 8.7% from 3%, while Capital Economics now expects 6.5% growth. That's not to say the economy is without challenges. Robust demand is further straining supply chains, and inflation has driven a collapse in consumer sentiment. Moreover, a pickup in COVID-19 cases in recent weeks could restrain activity through the winter. Meanwhile, wages and salaries rose 0.8% in October after a 0.9% increase, the Commerce Department's report showed. And a host of companies, including Macy's and Sherwin-Williams & Co., are raising wages and boosting perks in a war for talent. If wage growth is sustained at the current pace, spending can remain torrid even without new government help and in the face of rapid inflation, Stephen Stanley, chief economist at Amherst Pierpont Securities, said. Personal income climbed 0.5%, even as government assistance to workers during the pandemic subsided further. The savings rate, or personal savings as a share of disposable income, fell to 7.3%, more in line with pre-pandemic readings and signalling Americans have less of a cushion. Disposable personal income, or after-tax income adjusted for inflation, fell for a third month, dropping 0.3% in October. Inflation-adjusted spending on merchandise rose 1% last month, while outlays for services increased 0.5%. The core price index, which excludes food and energy, rose 4.1% from a year ago. That's the most since 1991. And looking ahead, inflation is expected to surge even higher in the coming months as persistent supply chain challenges and ongoing hiring difficulties push prices higher still. The labour market continues to show progress towards the Fed's maximum employment goals as jobless claims fell to the lowest level since 1969. The Department of Labour reported on Wednesday that 199,000 people filed for unemployment insurance. That's down 71,000 from the prior week's upwardly revised 271,000. That was well below consensus for claims to fall to 260,000. Economists, however, shrugged off the huge drop in claims as a one-off, which were pushed down by a seasonal adjustment quirk, said Pantheon Macroeconomics. It will substantially reverse next week, with claims rebounding to around 250,000. Jerome Powell, of course, has been renominated to lead the Fed. One factor to consider is the potential impact on digital currencies. In fact, Powell appears to be deliberately avoiding the central bank digital currency hype, despite many other central banks pushing hard for CBDCs. He's consistently splashing cold water on that idea. But given the benefits the US gets from the US dollar as a global reserve currency, this perhaps symbolises a break with globalist interests in favour of American banking interests. Investors know that a rising dollar hurts the global economy. Most debts are denominated in dollars. As the dollar rises, it becomes much harder to service those debts. The world does better when the dollar is weakening, but is pulled into recession as the dollar strengthens. Now, Bitcoin has retraced from its $65,000 level to around $57,000, and Ethereum is also lower now. One interesting observation is that, with a bit of a lag, the US dollar, as measured by the DXY, and Bitcoin do seem to move together. This is not a cause and effect. They are both benefiting from the same market conditions. The dollar rose first in June 2021, following it a month later actually, by Bitcoin. Then again in September 21, followed a month later by Bitcoin. Most recently, the dollar began surging in the first days of November. Now, if Bitcoin is to follow that correlation, it should begin to rally again right at the beginning of December. But here's another point to reflect on. People wrongly make claims about money printing and inflation. The dollar is strengthening. Now, the inflationists say the dollar index is measured against other currencies, so they are just devaluing faster than the dollar. That's wrong. Check out oil. High, but not close to all-time highs. Silver and gold, interest rates, etc., etc. All these things point to the dollar not inflating rapidly. Now, if we also compare CPI inflation for these other currencies, European CPI, based on a basket of goods, is around 4%, while the US CPI is closer to 6%. What? CPI is telling us that the US dollar is devaluing faster versus a basket of goods than the euro, but the dollar index, majority weight against the euro, is spiking, which implies the opposite. How does that work? Well, the solution to the problem is QE, and government spending are not money printing. They're just temporary market manipulations. CPI, or prices, is not actually inflation. Inflation is about money supply. Right now, prices are increasing due to supply destruction, not more money. And now let's look at some of the latest crypto news that follows on from that. The US Internal Revenue Service could seize cryptocurrency valued at billions of dollars that's linked to tax fraud and other crimes in the coming year, according to a key agency official. The IRS seized $3.5 billion of cryptocurrencies during the fiscal year 21, a figure that accounted for 93% of all assets seized by tax enforcement that year, according to an IRS criminal investigation annual report that was published recently. I expect a trend of crypto seizures to continue as we move forward into fiscal year 22, IRS criminal investigation chief Jim Lee said on a call. We're seeing crypto involved in a number of our crimes as we move forward. In the past year, the IRS's criminal unit seized billions of dollars worth of Bitcoin and other virtual currencies, including $1 billion stolen from the Silk Road, an online Bitcoin exchange that was shut down in 2013. Congress recently granted the IRS more ability to surveil cryptocurrency transactions in the infrastructure package President Joe Biden signed into law on Monday. That law will require crypto brokers to track and report transactions to the IRS in an effort to give tax authorities more visibility into virtual currency trades. The agency could also benefit from an additional $80 billion in funding that Democrats are proposing in Biden's Build Back Better plan, which could get a vote very soon. Lee said that money is desperately needed in his unit to hire more than 250 to 300 special agents, as well as to invest in systems to identify and track cyber crimes. In your introductory note, CI chief Jim Lee also highlighted the first ever sentencing of a Bitcoin case with a tax component. In November 2020, a former Microsoft software engineer received a 9-year sentence for a scheme using Bitcoin and digital gift cards to defraud the company of $10 million. To further its efforts at combating the illegal use of cryptocurrency, the CI plans to launch a collaboration and data center in Northern Virginia next year. The speed at which money moves is already instantaneous, and the convenience that comes with that opens the door for criminals to exploit the latest technological advances, Lee wrote, and he added, CI has committed to staying ahead of these developments, and we've made significant investments in training our employees in the latest tactics and techniques to be successful in a digital financial world. Now, over in India, there's a spotlight again as Prime Minister Narendra Modi's government said on Tuesday that it was preparing to introduce a bill prohibiting all private cryptocurrencies in the country. Included in the legislative agenda for the winter session beginning on November 29, the Cryptocurrency and Regulation of Official Digital Currency Bill 2021 is also seeking to establish a framework for a central bank digital currency, which will be issued by the Reserve Bank of India. Though the bill includes banning all private cryptocurrencies, it would still allow the promotion of the underlying blockchain technology and its potential application. The bill actually was first proposed in January this year and appears to be unchanged since then. In response to the move, Indian crypto businesses have formed associations to lobby the government for a regulatory framework that would strike the right balance between the state and the crypto industry. However, the devil is in the language, which leaves plenty of room for interpretation. It's not exactly clear, for example, what the bill implies with the terminology of private cryptocurrencies. Private could refer to coins like Monero, Dash and Zcash, which are capable of obfuscating transaction information to offer privacy to users. On the other hand, stablecoins like Tether and USD Coin can be considered private cryptocurrencies since they're issued by privately owned companies, Tether and Circle respectively. Harping on the term private cryptocurrency suggests that the policymakers are still grappling with the nuances of this transformative and rapidly evolving technology, Sarat Chandra, a blockchain and emerging technology evangelist, told the Indian Express. The news of the Cryptocurrency Regulation Bill tabled for consideration led to immediate speculation that a blanket ban on crypto in India would force local exchanges to stop operations. The panic ultimately created a sizable arbitrage opportunity for traders between the two markets. At one point on Tuesday, the discount for USDT reached as much as 15% on leading crypto exchanges like WireX and CoinDCX, while maintaining the expected one-to-one peg with the US dollar on foreign platforms. Crypto business leaders in India have already chimed in, suggesting that the latest news is just the beginning of more to come. This is not the end, but the beginning of crypto regulations in India, tweeted Nishal Shetty, a founder and CEO of WireX. According to Shetty, there will be discussions, but ultimately innovation will win. This is not the first time India has weighed anti-crypto legislation. A controversial 2019 draft bill proposed a widespread ban on cryptocurrencies, going as far as including up to 10 years of imprisonment in cases of direct or indirect use of cryptocurrencies. The legislation never became law, however, but this week's news indicates that the government is again mulling its options. As one of the fastest growing crypto markets in the world, India's stance on the industry could likely ripple around the world. Data collected from blockchain analytics firm Chainalysis ranked India second in terms of its adoption metrics. The firm measured the amount of on-chain crypto value received, on-chain retail value transferred, and peer-to-peer exchange traded volumes between June 2020 and June 2021. Emerging economies like Vietnam, India, Pakistan, Ukraine, Kenya and Nigeria dominate the 5 top spots, with Chainalysis citing large transaction volumes on local peer-to-peer platforms as the prime driver. Now, over in the US, Sherrod Brown, chairman of the Senate Banking Committee, is probing some of the biggest stablecoin issuers and exchanges for more information about the risks that digital tokens pose to investors and consumers. In letters to executives at Tether, Coinbase, Binance and 5 other companies, Brown asked for more details about the size of the market for digital coins, how tokens are converted to US dollars, and how consumers exchange cryptocurrencies, among other questions. The complex terms and conditions applicable to digital assets and stablecoins, as well as the need for reliable and resilient underlying networks, can make it difficult for investors and consumers to fully understand the details of how these assets function and their potential risks, Brown wrote, asking for a response by December the 3rd. The centre also sent letters to issuers including Gemini, Stablecoins are a crucial part of the crypto ecosystem as they often are used to bet on other coins. Brown said he wrote to stablecoin executives after a group of financial regulators issued a report that highlighted the concerns about the burgeoning industry. Earlier this month, the President's Working Group on Financial Markets said tokens could threaten the US economy and that more rules and oversight is needed for the industry. And back in early November, the federal agencies took their first step towards regulating stablecoins, raising concerns that the tokens could threaten the US economy while making a bid back on the bitterly divided Congress to put guardrails on the fast-growing market. The Treasury Department's Federal Reserve and other regulators urged lawmakers to let them police stablecoin issuers like banks with robust capital requirements and constant supervision. But as a plan B, the watchdogs made clear they would activate a rarely used power to examine whether the coins pose a systemic threat to financial stability, a review that could trigger a raft of new rules. The 26-page document from the President's Working Group on Financial Markets represents a watershed moment for the $130 billion stablecoin market and cryptocurrencies worth trillions that it underpins. The industry has so far operated with little government oversight, and the President's Working Group is sending a clear message that era is coming to an end. The rapid growth of stablecoins increases the urgency of this work, the regulator said. Failure to act risks growth of payment stablecoins without adequate protections for users, the financial system and the broader economy. The coins are called stable because they have a value tied to that of another asset, such as the US dollar. Stablecoin issuers say they achieve that peg by keeping an amount of reserves that's equivalent to their tokens in circulation, and they typically guarantee that investors can exchange their tokens for actual currency at any time. But regulators have long been concerned that the pledge could ring hollow, particularly during a crisis. Though some stablecoin issuers predict they will be widely used for payments and remittances, most investors for now rely on the coins as a parking place for money they want to invest in Bitcoin and other cryptocurrencies, or as a means to easily transfer money across crypto trading venues. Tether is the biggest stablecoin with a value of more than $70 billion, according to CoinMarketCap. Though stablecoins are currently a insignificant part of the global financial system, the report shows that US regulators are keenly aware of how fast that can change, and the report expresses concern that stablecoin users could fail to protect their reserves, or that the reserves could fall in value, making it difficult or impossible for users to exchange tokens for actual currency. A loss in confidence in a stablecoin could also cause a run on the issuer, leading the company to unload assets in a fire sale and to risk not being able to meet redemptions, the report said. And that could lead to runs on other stablecoins and to a shock to the broader financial system. Similar issues could arise if payments using stablecoins don't process or settle as expected, the regulators said, and if certain stablecoin issuers continue to grow rapidly, they would eventually pose a systemic risk and wield too much market power. So the report urges Congress to pass legislation that requires stablecoin issuers to become banks with insured deposits, capital and liquidity requirements, and Federal Reserve supervision. In fact, companies could be prohibited from offering payment stablecoins unless they are insured depository institutions. And the regulators added that any action Congress takes should give federal agencies flexibility to respond to how stablecoins evolve, because the market is, quote, an emerging and rapidly developing type of financial asset. Treasury officials said they'd already held preliminary discussions with Capitol Hill aides on crypto oversight. Now, it's far from certain that Congress will do anything, considering that Democrats and Republicans have failed to agree on much in recent years, and also, of course, lawmakers don't have a great track record of passing legislation until a calamity forces their hand, as was the case when they finally brought oversight to derivatives after the 2008 financial crisis. But my point today is that there is a degree of complexity here below the waterline, and the interplay between inflation and central bank activity, the reserve currency, the US dollar, and cryptocurrencies and how they're regulated are all tied up as part of the same bundle. I'd also make the point that the more regulators impose rules and regulations on the crypto markets, the less pure they are becoming. And remember that crypto was ultimately defined as devolved, controlled by no one, and effectively self-accounting and effectively self-reconciliating. So if in fact exchanges and other players need to hold capital and act more like a bank, what we've actually just done is imposed the existing regulatory frameworks and processes onto a digital alternative. That could prove to be very interesting, and for crypto purists, they would hate it, because by definition it's driving precisely in the opposite direction from the one that they desired to go. This is going to run and run. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.